Is Bitcoin cycle broken? Stay tuned in the video and find out.
And before we start, guys, I just want to let you know that I'm not your financial advisor and that you should make your own decisions before investing into a project. For more than a decade, Bitcoin investors have relied on one simple assumption: the 4-year cycle always wins. Every cycle looked different on the surface, but underneath the pattern remained surprisingly consistent. A Bitcoin halving would reduce new supply, demand would gradually increase, capital would flow into the market, and eventually we would see another major bull run followed by a powerful correction. It happened in 2013, it happened in 2017, it happened in 2021, and most investors expected it to happen again after 2024 halving. But as we move through 2026, something feels different. Bitcoin isn't behaving the way many cycle models predicted. The explosive post-halving move never fully materialized. Institutional investors now control a significant portion of market activity. Governments are introducing regulatory frameworks instead of outright bans. Spot ETFs have fundamentally changed how capital enters the market, and macroeconomic conditions are influencing Bitcoin more than ever before. As a result, a growing number of analysts are asking a question that would have sounded ridiculous just a few years ago. Has the Bitcoin cycle finally been broken? And honestly, when you start digging into the data, it's not a crazy question. Because if you look at Bitcoin through the lens of previous cycles, a lot of things simply don't add up anymore. The traditional models are becoming less reliable. The market participants have changed. The flow of capital has changed. And perhaps most importantly, Bitcoin itself has changed. So in this video, we're going to examine why so many investors believe the 4-year cycle may no longer apply, what's actually driving Bitcoin in 2026, and what could happen next if the old rules no longer work. The 4-year cycle has been one of the most successful frameworks in cryptocurrency history. Its logic was simple: Bitcoin supply issuance gets cut in half approximately every 4 years. Less new supply enters the market, scarcity increases, demand eventually overwhelms supply, prices rise. And historically, that's exactly what happened. But there's a problem. Every cycle has become less dramatic than the one before it. The percentage gains have decreased, the volatility has decreased, and the market has become significantly larger and more mature. In 2013, it didn't take much capital to move Bitcoin. In 2026, Bitcoin has become a global asset traded by institutions, governments, hedge funds, corporations, and millions of investors around the world. The larger an asset becomes, the harder it becomes for historical growth rates to continue. And that's where the traditional cycle theory starts running into trouble, because the market structure that created those early cycles may no longer exist. If there's one factor that has disrupted historical Bitcoin patterns more than any other, it's institutional adoption. Previous bull markets were largely driven by retail investors. Social media hype, speculation, FOMO, momentum trading. Today's market looks completely different. Large financial institutions now have direct exposure to Bitcoin through regulated investment products. Major asset managers offer Bitcoin investments vehicles. Public companies hold Bitcoin on their balance sheets, and professional investors are increasingly treating Bitcoin as a part of a broader portfolio strategy rather than a speculative gamble. This matters because institutions behave differently than retail traders. They accumulate differently, they manage risk differently, and they often invest with much longer time horizons. Instead of creating explosive vertical moves, institutional participation tends to create more stable and gradual trends. The result is a market that behaves less like a speculative asset and more like a developing finance asset class. And that's a major reason why many analysts believe the traditional cycle may be weakening. Another major difference between previous cycles and today's market is the growing importance of macroeconomics. A decade ago, Bitcoin largely operated in its own world. Today, that's no longer true. Interest rates matter. Inflation matters, global liquidity matters, central bank policy matters, geopolitical events matter. In many ways, Bitcoin has become increasingly connected to the broader financial system. When liquidity expands, risk assets tend to benefit. When liquidity contracts, risk assets often struggle. And Bitcoin has increasingly shown sensitivity to these conditions. This creates a situation where halving events alone may not be enough to drive the market. Instead, Bitcoin now exists within a much larger economic framework, and that framework is often far more influential than the simple supply reduction narrative that dominated earlier cycles. This is where the debate becomes interesting, because there is an important distinction between a broken cycle and an evolving cycle. Many investors assume those are the same thing. They're not. A broken cycle implies that historical patterns no longer matter. An evolving cycle suggests that the underlying principles still exist but express themselves differently, and there is evidence supporting both views. The bullish argument is that Bitcoin continues to experience long-term adoption growth. Supply remains limited, institutional demand continues to increase, and global awareness continues to expand. The bearish argument is that Bitcoin has matured to a point where historical cycle models can no longer generate reliable forecasts. Both perspectives have merit, which is why predicting Bitcoin has become significantly more difficult than it was during previous cycles. If the traditional 4-year cycle is truly weakening, investors may need a completely different framework. Instead of focusing exclusively on halving dates, market participants may need to pay closer attention to global liquidity, institutional flows, ETF demands, regulatory developments, interest rates, and broader economic conditions. These factors may increasingly determine Bitcoin's future direction, not because the halving no longer matters, but because Bitcoin has grown into something much larger than the market it originally emerged from. And that's perhaps the biggest takeaway from all of this. The question isn't whether Bitcoin is dead. The question isn't whether adoption is slowing. The real question is whether Bitcoin has finally become mature enough that the old playbook no longer works. Personally, I don't think the Bitcoin cycle has disappeared, but I do think it's changing. The market of 2026 is fundamentally different from the market of 2017. Different participants, different capital flows, different incentives, different risks, and different opportunities. The 4-year cycle may still exist beneath the surface, but if it does, it likely won't look the way it did before. And investors who continue relying exclusively on historical patterns may find themselves increasingly surprised by what comes next. Because whether the Bitcoin cycle is broken or simply evolving, one thing becomes clear. The future of Bitcoin will probably be determined by far more than halving alone. And that's what makes the next chapter so important to watch. Do you think Bitcoin cycle is broken, or it's simply evolving into something new? Let me know in the comments. So guys, that will be everything for this video. I hope you find this video informative and entertaining. Don't forget to share this video, subscribe to this channel, like it, and turn notification on. Join this amazing project and check all of this information for yourself. And I hope to see you guys in the next video. Bye.